a program manager with City of Tempe. On behalf of the city, mayor, and council, we appreciate you all being here today and that you've taken the time to take part in this learning today. And hopefully you'll also find it very interactive and helpful to you and your businesses. I know in the business outreach that we do in economic development that we really kind of primarily hear about two topics much of the time when we talk to especially startups and small businesses in our community. And those are really talent pipeline development and finding the right folks to fill those positions in their companies, and capital. So we've got a great topic here today and terrific speakers. And just want to thank Yelton and Associates for helping to put this together for us today. And hope you all enjoy and will participate with us. And without further ado, I'll turn it over to Donald Laughlin, who will be introducing our panel and working with you all today to present this topic.
Hi, everybody. So Jill originally asked Russ, you need to meet Russ back here. Russ, wave your hand. He forbid me from putting him on the panel, so I have to at least introduce him. And then in conversation, we turn to what kind of topics are really beneficial for the business environment. This topic comes up frequently, as many of you know, and we decided and opted to do a little more thorough kind of presentation. That's why it's a series of 3. So many of you have the flyers. Notice the dates. It's the last Wednesday of each of the coming months. It's going to be the same panel, and the whole point is to get used to some of the resources that are in the environment to support you as business owners and executives go through the capital raising process. I equate the capital raising process like learning to drive. Before any of us drove, this concept of driving was really overwhelming, right? I got to steer, I got to manage the gas pedal, the brake, maybe even the clutch, the blinkers, the wipers, I got to keep the car in between the lines, I got to be aware of the front of the car and the back of the car and the sides and all these other cars. It's overwhelming, right? Because there's so many different things. The capital raising process can be overwhelming. It doesn't need to be overwhelming. The purpose of these 5 people being up in front of you is because they each bring significant experience in the capital raising process. The point of this workshop is to give you a chance to ask questions, which will directly relate to how much you individually get out of it, and to learn about the process. So if we could do some introductions, please. Michael, would you start? And if you can turn your mic on and then turn it off when you're done, we'll kind of walk through this process, please.
Mike Patterson, Spencer Fain Law Firm.
So Mike is our legal representative relative to this process.
I'm Chris Roden. I'm a private equity investor. Company is called Camino Capital. We invest primarily growth capital in small companies. We've done 100 transactions since 2003, and I'm here to still talk about it, so that's a good thing. But anyway, our best relationships are with entrepreneurs that have live growing businesses, and we participate in that.
Chris is unique in that there's lots of capital providers that only focus in larger kinds of spaces. This workshop is around helping businesses that are younger. So his perspective is going to be directly related to businesses that are younger. That's why he's important in this role.
Thank you.
I'm Greg Colton, and I'm with Western State Bank. We're a larger community bank, headquartered in North Dakota. We specialize in closely held businesses of all types, and I've been involved with owning a bank and fortunately selling a bank and other aspects related to investment banking.
Awesome.
I'm Richard Swatonic. I'm with Lovett & Touche. We are a commercial insurance broker, primarily focused on the middle market, but we do scale down, scale up a little bit, so we can work with companies that are early stage all the way up to whether you've got hundreds of millions of dollars. We work with even publicly traded companies. Me particularly, I like to work with growing companies because I think that's a little bit more fun, and I think we can add a little bit more value. My background is more originally corporate finance, so I kind of look at everything through a little bit of a corporate finance lens and how that applies to insurance and how insurance can be a vehicle to help secure your assets and help you with the company as it grows.
I'm Cheryl Folkerth. I'm with REDW LLC, and I represent CPAs. We are a full-service accounting firm. We do audit and consulting, tax, business valuation, forensics, HR consulting. We also have management advisory and accounting services, so we're perfectly positioned to help a small business get started because we can help you with everything from historical accounting to CFO services.
Awesome. Thank you. So for our audience, here's a few questions relative to where you're at in this process. So I know that there's several of you here from the banking community and the finance community. But for anyone that's in the process of either preparing a company or helping a company prepare or going, kind of in the middle of it right now, show of hands so we have an idea of how to kind of tailor our answers. Who is involved in any stage of raising capital right now? Okay. Who has no experience raising capital and wants to learn? Okay, fair enough. So that helps us out, know how to answer some questions. So, and again, as you heard me say earlier, you'll get out of this how you participate. So I appreciate that some of you have note paper out and pens and those kinds of things, but this is also designed for you to ask questions. So at any point in this process, for those of you that I know are gathering capital or seeking to learn, please ask questions. Fair enough? Okay, so our first question that we're going to use to kind of kick this off is, and the scope of this workshop is all around preparing a company. The second workshop in a month is, now that your company is prepared, how do you actually go through a capital raise? And this is all on your flyers. The third one a month after that is, now that you've gathered money, what does it look like inside the company? How do I manage this? So this topic of how do we prepare a company to raise capital? The question that we're going to start off with is, what is the process for preparing your company? Who'd like to start? Go ahead, Chris.
I would say the process to begin is to sound so fundamental, but it's so true, is to have good books and records. And that sounds like a given. I'm here to tell you it's not. Okay, so understanding where your company is, are you making any money? Do you have positive cash flow? And how do you monitor, what's your financial control architecture look like? I'm a small business person. Most entrepreneurs view a controller or CFO as overhead, so they rarely invest in it because they can't. And that's a hard thing, but you're not going to raise any money unless you have good financial controls and good reporting capabilities. You're going to beat your head against the wall, so that's a square one question, and you've got to be able to check that box.
Can I add to that? Yeah. Get good books and records. Just kidding. By the way, I didn't say I'm a lawyer. I didn't finish. We're 300 lawyers in 20 cities across the company, but I'm in our Phoenix office, and we do everything business. And I happen to be a corporate securities lawyer, but do a lot of international and distribution as well. But on that books and records side, I've had a serial entrepreneur client who just commented to me that he says, every time now that I start my new company, I open the data room on day one and start, here's the legal documents, here's my financials, and he starts cataloging because he's been through several capital raising and M&A and exits, and he knows that eventually you have to show all this to someone. They sign an NDA and they look, right? And so he just starts getting organized from day one. And I thought, that's brilliant. That's awesome. Another thing is, in the getting ready process, I assume that you started this business, whatever it is you're doing, the widget that you create solves some sort of a problem out there in a way that someone else is not solving it, right? And you differentiate yourself, what makes you unique. And if you don't solve a problem, you won't be in business for very long. But if you do solve a problem really focus on what is it that makes me different. But you're going to eventually, when you raise capital, need to tell that story and get to the point and be real clear about what makes you different from everybody else that's out there, okay? Why your widget is different from everyone else, and get right to that point. It's really important then that if you have intellectual property, that you protect that intellectual property during this get ready phase. If you don't get your patents and your trademarks and your protection of that intellectual property, you won't have any story to tell by the time you get to investors. And one thing I would just say as a caution, I hear frequently and have to have this discussion with people that come into my office is, well, we got to go raise some money before we can do those patents, et cetera. It's the chicken and the egg. Well, I will tell you, the clock is ticking. Once you start talking to people, to third parties, even investors or people that could be suppliers or people that could buy from you, people are in a hurry to get out there and start talking about this great idea. But if you start telling about the secret sauce, the time clock begins ticking on when you can file a patent on that idea, a year, basically. And some people say, well, I signed an NDA with them. Yeah, you just documented with a date on a piece of paper the day you started talking to someone about that. And that NDA is not necessarily going to protect you from the time period that you had to get out there and protect that thing. I have a couple other things. Your idea of what makes you different, you're eventually going to come to the point, next month we're going to talk about your document that's going to say, I want to raise this much money, and here's what I'm going to do with it. We call that use of proceeds, okay? So you need to have a clear business plan right now. What is it that our company does? How many people do I need to do that? What kind of people? How am I going to execute? And how am I going to get from point A to point B to point C? That's key, that plan and your ability to execute that, and then putting together the executive team at the right moment when you can afford it and when you can attract these people when we get ready and come next month and talk to you about, okay, here's the process. These investors are going to want to know, do they have a plan? Have they protected their intellectual property? Do they have a team? I don't care if they have the cure to cancer. I don't care if they have, the new bread slicer that changes the world. Do they have a team that can execute that and get them from A to B? So I have others, but I'll stop talking for a moment.
I was going to mention one thing, just kind of piggyback on what you were talking about, that initial information gathering stage. If you've never gone through that before, it can be very painful and very eye-opening, because a lot of times entrepreneurs tend to be a little bit more closed in. They're like, they don't want people to know how much money they're making or who they're hiring or who they're paying what. So it is a little bit of a mind shift that you've got to get over that and just realize that you're going to be sharing a lot of information, and some of the information requests may become cumbersome at times, and you think when you provided everything, then they come back and say, no, we need more information. So it can be painful, so I would just say prepare yourself for that process as well.
And to piggyback off all the books and records comments, which I'm a fan of, you have to know your numbers. You have to be able to support and have credible information for where you came up with your revenue projections or how much your widget costs you. And if you're just starting out, you're probably just scrambling around trying to get money from everywhere. I would suggest you get one credit card, use that credit card exclusively for your business. Don't mix it in with all your personal stuff. That just makes things messy, and when it comes to disclosing information, you may have to disclose more than you'd like.
Just to chime in a little bit on all the conversation we've just heard, as a banker, I meet with a lot of business people, startups, early stage companies. One of the things that's really critical to a business moving forward is picking your right advisors. When you're going to start a business, you're going to build a business plan. It's kind of like hearkening back to when you had to do a paper or do some research work. You got to put your thoughts down in a very logical manner on paper, understanding your business plan and the structure and the ideas with which you're going to move forward. then the next most important step is, who am I going to get as an advisor? Who am I going to talk to about my business, whether it's early stage, whether it's startup? You know, we always in the banking business look for the advisor, good attorney, good accountant, good insurance agent, people that can give you sage advice on these are the things you need to be looking at. And look at it very objectively. There's a lot of emotion when you start a business or your early stage and you want to have all that success. Kind of look at it objectively, as though you were being asked to invest in your own business. How and what would I ask? What kind of questions are going to come up? How am I going to approach this business plan that I'm going to give to either an investor or a bank? A lot of times when we see early business plans, they lack a lot of the detail necessary to really make a good business decision as to whether or not that business is financeable. So I would say do your homework on the front end. Really vet your business plan thoroughly, whether it's a startup, early stage, mid stage, because when you get into the larger firms that are looking for a more structured financial plan for private equity, next stage capital, they're going to really require a lot of good, solid financial information. If you're a startup, then obviously your capital raise is going to have a different attribute to it. So do your homework, get good advisors around you right out of the blocks, and take as much emotion out of it as you can, because it's a business, it's objective.
Just want to do a follow-on on that. You know, as a private equity guy, I've been doing this 35 years. There's more capital available right now than there's ever been in my entire life. It has its own requirements, and not every deal is for every investor, but money is available. Number two, and you hit on this a little bit, which is so true. I'm a financial guy. I don't, but my first underwriting is not on the numbers. It's on you and your ability to execute that business plan that everybody up here has talked about. And what your team, because the bet that I make every day of my life is, can this team execute this plan, even though they've never done it before? That's why risk is a four-letter word, right? So I think that, understanding that and convincing people that you can do that is the most, if you take nothing away from what I have to say today, it's not the evaluation of the numbers. Quite frankly, a monkey could do the numbers, right? It's not that hard anymore. The technology that's available and the tools that are available to you as an entrepreneur to produce a quality business plan and numbers that you can believe in is readily available. It's not a problem. What's not readily available is your skill and alacrity as a management team. So half of my job every day is really HR related. How can I get the right people in the right jobs to execute the plan that I've invested in? It sounds simple. It's not. So when you evaluate your own businesses and you're going to ask, your comments are absolutely correct. Who are your, it's painful, it's expensive. Get the right advisors. Totally agree. Make your life easier. Keep good books and records. It's worth more to you on the way out if you have good books and records, because you don't start that a year before you sell your company. You start it on day one. But don't underestimate the importance of yourselves in that equation and the team that you hire. That's the critical success factor here. It is the most important thing that we look at.
So now is the point where we pause, because this team of people just gave you all the secret sauce. Now it only gets more complex, but from a high level, those 7 primary points maybe, and within those high level 3 or 4 key ones, that is the process of preparing your company to raise capital. There's a bunch of financial people in here from FEI that raise capital every day. There's some bankers in here in the audience that raise capital every day. There's some people from industry. Scarlett, if you want to add to this, feel free to jump in. So now is the point for those of you that are raising capital to pause, think through this list and say, I got a question about this point. What does it look like? Or can you give me more information? Or where do I gather this information? Or How do I actually engage a CPA to help me in this process? Or what legal documents do I really need? Ask some specific questions that are going to help you out and move the ball forward for you. That's my encouragement. Who will start us off? Would you just repeat the question?
Okay. If someone is in the process of starting up a new company, what's the first step they have to take from an attorney's perspective? Getting legal documents in place.
First question is choice. By the way, it's a great question. You do need to have an entity for limited liability. I don't want to assume that everyone's unfamiliar with that, but the reason we create limited liability companies and corporations is so that the equity holders are not responsible directly for the debts of the company or the liabilities or lawsuits that come against the company. They're not going to go after your house unless they can pierce through that corporate entity, whether it be a limited liability or a corporation. That's why we limit liability in creating entities. The next decision, so that's the right thing to do. It's quick and easy to do it. Can form one in a week, or actually in a day. You can actually get the shell of the entity formed for the limited liability. However, the type of entity, the choice of entity, and jurisdiction is probably the first conversation that I would have with you, and may rely on some of your other professionals on your tax situation. Are you looking? Thank you. Are you looking to do a group of companies? Will there be a management company? Is there several segments of your business? One, we want an entity over here hold the intellectual property and that kind of. There's some structuring that we could talk about. But let's just assume that in the beginning you're going to form an entity. By the way, over 90% of all entities formed in Arizona are limited liability companies now. They can choose what we call C, to be treated as a corporation, C corporation status, or pass through. A lot of flexibility with that kind of entity. And yet there are some expectations in Chris's world. If you're headed for a certain type of entity in a certain industry, and if you're thinking of a certain type of capital raising in a couple of years, you may start, or there are other tax considerations, you may start with a C corporation or do an LLC and convert to one. It's possible. And then Delaware is the big kahuna out there that's very well respected by big capital sources, but you may be a long ways off from that, and your trajectory may not be to do an IPO for your company. And so there's the choice of the entity has some market-driven factors, has some tax-driven pieces that go along with it, but get an entity formed, yes, before you start contracting and doing things individually with people. You don't want to be acting in your individual capacity that exposes your house and all your personal assets. You want to do this with an entity. Easy and cheap to form and get one up and going. They're easy to adapt and merge and change from C to S and from LLC to a corporation down the road. We'd like to pick the right one right out of the chute. Everyone would, but it's actually fairly easy to change later on, so don't lose sleep over that. But form an entity, so who to file with? There's 50 states in the United States. We don't have a federal. There's no federal LLC or no federal corporation. You have to pick a state. Okay, Arizona just went through an 8-year process of redrafting its LLC Act, which I happen to think is better than Delaware. And one of my partners was on the drafting committee for 8 years, and I was on it for 2 years. And we think this is a really great animal in Arizona, our LLC Act. And our corporate code has been updated as well. We think Arizona is very inexpensive place to do business corporately, and you have the option if you want to change and go to another state in the future, you can.
Cheryl, you want to weigh into this part of the conversation?
Yes. I would say you're excited because you're at the beginning of this process, but you also want to think about your exit plan. Because especially if you're getting into a partnership or whatever with somebody else, you want to know how you can take that apart eventually. I know that sounds like a downer, but it's true. Because you're basically getting married, and you're going to be in close contact with these people for a long time. So you want to be sure that you know how you can get back out again. Tax-wise, the devil's in the details. It depends on where you want to go, how you want to get there. That is a conversation you have to have on a one-on-one basis.
If you're more than one partner in your business or you have several members within your business, one of the things that I would strongly recommend you take a good hard look at your buy-sell agreement and how to cover that end, because it can be havoc to a business if they don't have a formal strategy in place for that buy-sell. Many times a lot of these partnerships are formed on friendships and very informal, and then you get down the road and it's like anything else, it isn't working, or your partner dies and his spouse is now the person you're dealing with. So to have a more formal structure to that front end with a buy-sell agreement and how that's all going to play out is really critical, I think, to businesses that are forming when there's more than one owner.
So Greg and then Chris, would you both comment on the structure question from your individual arenas? Greg, the banking arena, does the bank care what kind of structure? Does it make a difference on the eventual relationship? And then the same question for Chris inside of the private investing side.
When we see a business come to us, whether it's an LLC, a partnership, or a C corporation, it's really making sure, number one, that the paperwork is in order, the company is legally formed in the proper location, and the fact that they have a structure well explained about why the business is a C Corp, LLC, or a partnership, and who are the players. That's the primary first step we go through, is looking at the legal documents to see how is that entity formed, what does the operating agreement look like, what are the bylaws look like. We do that analysis.
Mike was right. The Arizona LLC statute is probably the best we've ever seen. Traditionally, people default to Delaware. But as a Westerner, we like to keep it here as a venue, which is a word you'll see being used for any dispute litigation. Arizona is a very good venue for that. Having an Arizona LLC, I think, I can't remember the last time I did an investment that wasn't through an LLC. Maybe it was a S corp. It's been a while, but always LLC. But I think the other item we touched on here, you mentioned operating agreement. This is a very critical document for us, and how people behave and treat each other in the company. Not everything results in litigation, but it's just important for you as the lead entrepreneur to have that understanding with your partners, if you have them, or other investors, on how are you really going to behave and how is this going to work. And you know, it's probably one of the most important documents that we look at. We spend time on it, and because we don't want, you know, as much as I like my friends in the legal industry, I don't want to pay for litigation ever. Okay, but you know, you resolve that early on. It's critically important, and you know what Mike talked about is, you know, you want to grow this asset, obviously, and make money, generate wealth, but you also want to protect what you already have. So one is a risk management decision, and the other one is a go forward decision.
I just want to add something structurally. If people are not familiar with the various animals that we're talking about here, thank you. These are wonderful things. If you have a corporation, the nomenclature or the language that we use for corporations is shareholders. Those are the equity holders. And then board of directors. And then we have officers, executive officers. Okay, that's what you talk about. And in a corporation, You have articles of incorporation is the document filed with the state. It's very short, generally a page, 2 pages, 3 pages, okay? Then you'll have bylaws. That normally sets out the rules for what if I lost my stock certificate? How many, do I have to have a majority for a quorum for a meeting? When do we meet? Who can call a meeting? That's the bylaws, okay? And then what Greg mentioned as a buy-sell agreement is normally within a separate document called the shareholders agreement. When you have multiple shareholders, initially they will agree that, hey, this is you and me and Sally, okay? And if one of us dies, I don't really want to be doing business with your spouse, your ex, or there's a divorce. This is us three, and this is how these are bought or sold or buy you out, that type of thing. And if we get to the point where I don't like your tie, I can make you an offer, you can make me an offer, shotgun buyout or something to get this done without us having to go to court and litigate to get the business over. Now let's move to an LLC. An LLC, all those documents that I just described, an LLC will have articles of organization, similar to articles of incorporation over here. The nomenclature is members are the equity owners, and the people who run the company, the executives, are called managers. So you've seen that title. You can also have over here manager and CEO, manager and CFO, et cetera. They can have other titles, but manager is the key in a manager-managed LLC. There's one mega document over here in an LLC that is your bylaws, it's your buy-sell agreement, it's everything. It's the waterfall on who gets paid first, all that. This big kahuna document called the operating agreement. It's private. It's not on the Arizona Corporation Commission website. The only thing people can see publicly is your 1 or 2 page articles of organization or your 1 or 2 page articles of incorporation. And all the rest of these documents are internal that only come out if someone litigates and discovery and all that. But they're private.
Good. Looks like we had another comment.
Chris mentioned one of my favorite words, risk. So that kind of perked my ears up a little bit. And, that's where we have the discussion about everyone's least favorite subject, insurance. I'll be honest with you, usually if I'm at a networking event or a party or something like that, and they say, Richard, what do you do? I said, I'm commercial insurance. The conversation pretty much stops right there. But it's actually probably step 2 in the process. Once you get the proper documents filed, you get your legal structure in place, you take into consideration tax considerations from a tax structure standpoint. I would suggest that, as you're building these assets, you want to protect them. There is risk there, so you want to protect the assets. And unfortunately, a lot of times, entrepreneurs or even just existing businesses think of insurance as an afterthought almost. And whereas it should be a little bit more proactive. I can't tell you how many times I've had conversations with people and we're talking about the business and how it's growing. And I'm like, okay, tell me more about your growth plans. And when do you anticipate hiring employees? Oh, we already have 10 employees. We hired them like 6 months ago. Do you have any insurance? Do you provide workers' compensation insurance? A lot of times the answer is, oh, I need that. I thought they were just contractors. No. So a lot of times, let's get the insurance in place too. Very simple policy for an early stage company. Typically a business owner's policy or a BOP, we call them. It's a very simple package of products. Will protect general liability, protect maybe there might be a little bit of directors and officers insurance in there, maybe a little throw in of some cybersecurity, but get a basic insurance policy to protect the assets of the company. And maybe we'll talk a little bit more about protecting the directors and officers later as well. Yeah.
Perfect.
I'm just going to add one comment to what Richard said. And you could pay me later, Richard, but I think that if you're an investor like I am, you only find out when you're underinsured, when you're vulnerable.
That's exactly right.
And, it happens. So as an investor, I actually have to read the policies. No owner will ever read the policy. They're going to put it in the file on the shelf behind them, probably on the lower left corner, and just say, okay, I've checked that box. Richard told me I need that. I've done it. I've paid my premium. I'm good. Not so fast. Because when you write that, give me 1 second, because when they write the policy, when do they understand what the business really is and what you do to add value and make money? And are those actions and those abilities covered under your policy when it goes wrong? And, having been at this a while, I can tell you I've learned the hard way. I read the policy. And to go naked is to be stupid. And I just, again, it's like hiring a CFO. It's like hiring the right lawyer or the right accountant. Yes, it costs money. I'm here to tell you it'll cost you more not to do that. If you don't do those things, you could lose everything. Sorry.
Thanks. No, great.
Go ahead.
Isn't this good stuff? Yeah. Wait.
I was just going to ask Richard to just give people a sense of, the cost, since you've got everyone, people are looking at early stage, just what that would cost so they can plan better.
I may sound, at the risk of sounding like an attorney, no offense, Mike, but the typical answer is it depends, right? It depends on the risk profile of the company, but usually early stage, you're going to want to see, you can get a policy for pretty reasonable price, whether it's $2,500 or $5,000 for just basic general liability, a little bit of property insurance, things like that. So in case again, it depends. If you got a retail facility where you've got people coming in and out, you're going to have slips, trips, and falls, and people are going to potentially file a suit against you. But you're going to be on the hook for that. So that's why you need something like that. So, in the grand scheme, early on, it's fairly affordable. It's when you start getting into higher, riskier situations, and you've got hundreds or thousands of employees. That's when it can get very costly. But then the programs get a little bit more creative as well. Is that helpful?
Excellent. Next question.
My question is for Chris. You mentioned that the most important thing is to find the right person or the right talent to start everything. So I'm an HR person, so I'm biased here and curious to see what is the process that you have to put the right person on the right seat. Let's say if you have to invite a bunch of people for interviews, what are your requirements or the methodology that you use in order to find the right person for that particular project?
Fair enough. You're right. It's not easy. And we're underwriting an investment. I've been doing this a long time. I can't evaluate the strengths and weaknesses of the management team or the leadership team over a steak dinner and 2 bottles of Cabernet. Okay, it doesn't work that way. Okay, it used to. We hire third-party independent people that are data-driven to tell us as investors, if I'm going to write a $10 million check, somebody's going to tell me what the skills of the management team are to complete the plan. And inevitably, it usually goes like this. And I have a CEO, and she's a great lady, works her butt off, and is producing really good results. However, that guy that's in charge of sales is kind of telling me what I want to hear. And they're going to tell me objectively. He's not going to move the needle for you. He wants to, but he can't. So then I have to go back in the underwriting process and say, we've got this feedback. We collectively have this feedback now that says this guy can't do what we need him to do. So we need to do something about it right now. Sometimes these are family businesses. That's a whole nother conundrum. Okay, but it's, the capital deserves its own respect. And why would you invest in a situation where you have a weak link? You wouldn't, you shouldn't, it's not right. So you're going to say, we're going to do this change. Getting the right person. So a lot of the smaller businesses, and I'm a small business guy, everybody in that vertical, in that industry. If you don't, then you should. And I think that trying to find the right person and providing the right incentives to get them to make a switch is not an easy equation. You're HR, you know that. But I think that what I want to communicate to you is, having real professionals evaluate the leadership team and understand, where your weak links are. These businesses, as you know, were usually started by one or two people. They've grown up, as Richard indicated. Now you blink and you have a couple hundred employees. The same man or woman that managed 3 employees is probably not the best to manage 300. And people have limitations. It's fair. We're not, but I'm investing so we get to 1,000 employees. And everybody does well when, rising tide will raise a lot of ships, right? But I think that I don't have a single answer for you. It's a very good question, but I think that it starts with, because if we invest in a company and after we invest we find out we have 2 weak links out of 6, shame on us. It means we didn't do our job. And if you're replacing a CEO as an investor, it costs 2 years in your timeline. Because first of all, I got to get rid of the first lady or man, and that takes time and money because I got to pay them to go away, right? All the more harder if it's a family business. And then I got to hire somebody to go find me somebody new and pay that fee, and then pay the contract for the new person, and then give them another 6 months to understand what is the culture of the company we're dealing with. And culture plays a very big factor. And the main difference between companies that make it and companies that don't is in the culture. The culture starts with the leadership team. And I think that, sometimes I need to hire people to change a culture. Okay, so when you're operating a private equity business and you're trying to have an investment horizon of 3 to 5 years, and you lose 2, and time is money, it's very painful. So I can't, but in your business, it's become increasingly data driven. It used to be, well, he's not the right cultural fit. I'm here to tell you, what does that mean? I don't know. Are we only going to hire people like ourselves? I don't know the answer to that either. So I depend on third-party professionals that say, these are the elements of this person's character. These are the elements of their behavior. And I don't care who you are, you have things in your life that you'd rather not share. Everybody does. So it's not the error of commission, it's the error of omission. Just tell us. We can deal with anything. Just tell us. So I think that I don't have a magic bullet for you, but it's the hardest thing we do. And it's not easy. So half an answer. I'm sorry.
Michael?
I just want to add to something he said, and he mentioned, and giving that person the appropriate incentives to be willing to come in. Yeah. That's an interesting comment, and if I could expand on that. For many founders who have slaved night and day for the last 2 years, really working crazy hours to get this company off the ground, et cetera, they get to the point where they're going to ask for capital, and they're saying, what? I'm going to give that much of my company away for that much money? That's like a triple bypass surgery enema. You know what I mean? It's just terrible, for people who've never gone through that. But we come back with, well, would you rather own 100% of an X company, or would you rather own 30% of a 10X company? You know what I mean? That's kind of some of the dance that Chris is an expert at. But on this, bringing in this proven track record executive or professional management that is going to fill a spot and take you from point A to B, that is also major heartburn for most founders, because they have been working at this night and day, and they want someone to come in and just kind of work like us. But you're going to find when that person comes in, if they're a real professional, they're going to ask questions like Rich is asking down here of, do you have D&O insurance? I don't want to be an officer or director in your company unless there's insurance for director and officers. They're going to ask, is there equity for me? What's my chunk of the equity? They're going to ask sometimes for options and incentives and an employment agreement that puts it all in writing and really ties you down. I mean, you're going to have to commit. And so that dance with the new person that comes in at that appropriate moment, if your finance partner says, you've got a hole here on your executive team, and you need to fill out your executive team. That may be quite a dance. You may need some help from some people to go through that appropriately and not give away too much, but also attract them to come in.
Great. Very good comments. Follow-up questions?
Yeah, in terms of pure economics, in the context of getting a company ready for a capital raise, do you find that an audit would pay for itself? If you had one, the numbers would be better and get to better terms or clarity on the value of the company, or if you didn't?
No question, an audit is best. Rarely do I get to see it in the lower middle market. You would help yourself tremendously, and accounting services have become very price competitive. And it's when when I'm at the entrepreneurial stage and, well, here's a file on QuickBooks and, and my lawyer is my golf partner. Yeah, he's a real estate lawyer. He doesn't know squat about what we're talking about. Okay, but this is what happens every day. This is the reality of life. And just to say, when you work up, what are my sources and uses? How much money do I need to start this business? Okay, and what's it going to take? And picking the right advisors and other elements that people on this panel have brought up, those are all important. But we understand that cash is a concern. Entrepreneurs are bootstrapping themselves every day. We get it. Okay, but at some point in your financial life cycle of your business, at least get a review or a compilation. Do something. So you're making your life for my banker friend here a lot easier, and for your insurance, everybody else said, okay, at least we can trust these numbers. Because when you go to sell that company, say 5 years from now, they're going to do a quality of earnings on you, okay? And, most of the work we do is what we call confirmatory due diligence. We're just looking to confirm what you told us is true, okay? But I think that, again, I could be wrong on my numbers, but even to get a review, it's a couple $1,000s. But to have a relationship with a qualified accountant, am I wrong, Richard? Is it more? It's more. Okay.
That number's really pretty low.
Okay.
Thinking more like 15.
I wasn't doing the right business development role, but to answer your question, so if you're going into a company like I am, and they say, and your point's well taken, with regard to having the right alignment of interests, right? Do we have the right management team? Do we have the right alignment of interests, i.e., are they getting paid? If somebody's going to come to you without that incentive, then maybe you should look at why you're hiring them, because any quality talent is going to ask you that. And I think that, when you go in for financing or any expansion capital or growth capital and say, here's my books and records, here's my finances, here it is. You will save yourself so much intellectual damage, you have no idea. And I highly recommend, again, I recognize, I've been at this, it all costs money. It does. But the cost of not having it at some point in your development and growth will be more than what you pay. And the same question, the same response Mike gave, I deal with all the time. Do you want to, Mr. Entrepreneur, Mrs. Entrepreneur, you want to own 100% of this or 90% of this? Because I'm going to demand equity in the equation. Again, it's about the capital deserving its own respect at the end of the day, and about me being a good steward of capital. That's why I get paid. But, if the entrepreneur is just wanting, to have a lifestyle business, then he or she is really not my client. That's fine too. And there are plenty of lifestyle businesses here in the Valley that quietly make $2 or $3 million a year, and that's fine. That doesn't interest me. I finance growth. And growth requires a lot. So, but I absolutely, in your development, when you think about your business plan, it doesn't have to be day one because you probably can't afford it. But at some point, you're going to have to get a review, a compilation, or an audit. And you'll be helping yourself to do so.
I think Greg's lined up for a comment. And then Cheryl, would you tell us after Greg, would you talk about quality of earnings report and what that actually is, please.
Yeah, we've been talking a lot about capital raising and the structure of these, not knowing the makeup of the audience. If you're starting a small business, you're starting a small company, or you have a small company and you're growing it and you're building it up, some of the metrics we've been talking about may not directly apply to you at that point in time. But looking at as you're progressing along your growth path of your company, you know, a lot of small businesses we see, they start out with a compilation or QuickBooks or some financial reporting like that, and they begin to build their company. They typically have sometimes it's a family business, they have the father, the son in the business, and it's growing nicely. And they get to a point where they've outgrown their, what I call seed capital, which is family capital, friends and family, that type of capital. And they now have to go to a more formal process of getting outside investors, and typically it's typically not the bank for those kinds of things. It's folks like Chris and others. And that's when you have to upgrade the quality of your financial reporting, because they're going to make a bet on understanding the management team, the quality of the financials that are being presented to them. And that's when you might have to step up to a review. And in cases where you've got an existing company that has really ramped up and really heading down the road to maybe a buyout or an IPO, you have to have an audit, because they're going to tear into those financials and unpack them very thoroughly to understand the metrics of those financial reports. So it just depends on where you are in the life cycle of that business. If you're a startup and you've got a lot of capital to start up and you've got a great business plan and you're going to be the next General Motors, well, that's a different animal than, hey, I got a great idea, I got a great team, there's only 3 of us starting it. That's a different exercise completely.
Quality of earnings report is a little bit forensic. So they're going to take apart your financials and see if they can support them in a number of different ways. So they'll go look at cash to make sure that supports the deposits you say you got, or tear apart your receivables and prove that the quality of your earnings is good, bad, or indifferent.
Next question. Here we go.
Greg, this is addressed to you. A lot of small startup family businesses have no intention of paying taxes, and yet when the time for growth comes, they want you to loan money. And as a regulated industry, can you address how that works and what you want to see?
Well, there's a lot of answers to that. A lot of businesses, they try to avoid paying taxes, as you just said. But when we look at a business and we look at their earnings trends and we look at what they've paid in taxes, we advise them there's nothing wrong with making profit and paying some taxes, because at some point, every business goes through a cycle. And if you have quality of earnings over a period of years, you have the tax advantage of looking back and recouping some of those losses through tax benefits. But if you don't make money in your business, you can't expect the banking industry to become your partner, because you've spent your entire time trying to avoid the tax man. The quality of the earnings in the company helps you to buy your fixed assets, help you with your working capital cycle. It helps you create strength in your company, avoid risk for the different cycles. So it's a common theme when I don't want to pay any taxes. I don't pay any taxes. Well, it's okay to do that if you've got an insurmountable amount of liquidity in your personal financial situation that you can become the partner to your business if you need to. But we see it all too often where they spend too much of their focus on trying to avoid paying taxes, and actually the business should focus on just making money. And then the ultimate time is not overpay taxes, but there's a balance there between having sufficient earnings to support the company's growth and paying Uncle Sam his due, because that's the beauty of making money. If you grow your company and you've never paid any taxes and you've got a break-even balance sheet for 10 years, you're not going to sell that company for the kind of multiple that you might envision. So
let me just say this on the same subject. If you're a business leader, a CEO, and you're making those decisions based on tax considerations primarily, not going to happen, okay? You've got to make the right business decisions to grow the business. And in my life, we deal with this concept called EBITDA. All right, I think that if you don't know what that is, I'm happy to explain it, but your earnings before interest, taxes, and depreciation and everything else. Because what I'm interested in is the ability of the business to generate cash. Okay, and if you're not generating cash, it's going to be a problem. But so sometimes, and this may be getting ahead, so if I am, but we structure our investment as a subordinated loan versus, or primarily as a mezzanine loan or an equity piece, because the interest is tax deductible. So on a net income basis, Greg is absolutely correct. On a net income basis, you probably will have a loss and you won't pay any taxes. But on a cash basis, because we add that interest back into your performance and evaluating your company, it looks a lot different. But I might be getting ahead of the equation, but it's
Little bit.
Yeah.
Great conversation. I know there's a number of people in the audience that haven't said a peep because you've been listening and taking notes and all those kinds of things. Another checkpoint. How are we doing? Good information? Is it scratching the itch that you need? I mean, is this really good for you? The point of this is it useful? Okay, last question, then we're going to move on to another topic.
So my name is David, and I'm an owner of Esperanza Analytics Solutions, data analytics company. Basically, my question is for Chris and Richard. What kind of insurance should I get? And what would you be looking for from a data analytics company in order to do an investment? I pretty much work on my garage with my own computer. I don't need more.
Well, for extremely early stage like yourself, if it's just yourself, what are the assets? That's what you want to think about. You're an asset. Your computer equipment is an asset. You want to adequately protect those assets. If you're talking about like a larger data analytics type firm, they may have a series of servers, other equipment. You want to make sure that those assets are protected. Also, from a catastrophic standpoint, what would happen if something catastrophic happened? Your garage catches fire, God forbid, or an office building experiences a catastrophic cyber attack, say, shuts everything down. You have zero ability to generate income. So that's where an insurance component of you've got business interruption, you've got business income insurance that would kick in to help you overcome and pay those bills while you're getting up and running or relocating to a new facility, things like that. But you I assume you're just a sole practitioner, just yourself with computer. You're probably fine with just a basic policy. Yeah.
So in my earlier life, when I was a younger man, we would never, as we would say, invest in companies where our assets were in the elevator every night, because they don't need to come back. So it's really hard to leverage those assets. Most banks won't do it. But in the digital economy, is where we are now, it's really hard. Most of the requests I see are from what we call human capital firms. People that are invested in each other and other people, but not hard assets that would excite a bank. The biggest threat we discuss every day is cybersecurity, particularly in somebody in your business. And, following, Richard's comments, do you have any intellectual property that merits protection? Or you're dealing with other people's information, should it be stolen, or you're going to be at risk? My answer is, you probably are, okay? And then, you're lucky to be in Arizona because it's a pretty safe state for that. If you were in California, I would say you're not. California, I really hate the place, to be honest, as an investor, because it's litigious. I can't fire anybody even for performance without getting sued. I can't do anything without getting sued. It's like, litigation expense is not a one-timer. It's an every month item in the income statement. That's right. And so I think that, whatever, and this is sound really simple, but it's true. How could you get screwed? If your garage burns down, you're done. If you don't have business interruption insurance, you might not make your payments. if you have employees, sooner or later, they're going to sue you. You have to have workers' comp, you have to have this, you have to have that. It's just fact of doing business. But my very limited knowledge of what you're doing on a daily basis, if your information is in the cloud, you're at risk. There are a lot of companies here in this town that I work with that are still on server-based technology because they don't trust the cloud. And unfortunately, or fortunately for them, there's a fair amount of evidence to support that.
I can't underscore the importance of cyber protection. It used to be all the large corporations, we all heard about the Target breaches, the Equifax, all things like that, but the hackers are coming downstream significantly. Every company is almost at risk now. And it's a little bit scary, but yeah, I've heard way too many stories of just some small company with, they got a handful of CNC machines. They come into the office, the shop one day, they're all shut down. There's a message on their computer screen that says, hey, just send me some Bitcoin. I'll turn your machines back on. And they're shut down and dead in the water. One, how do you get Bitcoin? I still don't know how to get Bitcoin. But you have to have that in place. And also just the sheer notification costs of a breach, depending on I don't know who your clients are, I don't know how much data you have or how confidential it is, but should that get out, that creates a problem. And people that deal with a lot of personal information or a lot of data files, that's at risk. And just the sheer cost to notify everyone of the breach could exhaust all the limits of the policy. Now, a lot of times there's a very simple throw-in, we call it just a throw-in coverage on a lot of these smaller policies. And they think, oh, I'm covered. I got cyber. It's in my policy. It's, maybe it's $100,000 coverage. That's gone like that. It's gone. So a lot of times you do need a standalone cyber policy, depending on the nature of your business. And even cyber is getting, for larger companies, it's getting a little bit more problematic in that when there's a breach, the cyber limits are being exhausted. Now people are filing suit against the directors and officers of the corporation because they didn't adequately protect the company from a cyber breach. They didn't have adequate limits, things like that. So we're starting to see a lot more litigation in that area, and unfortunately that's going to impact premiums at some point.
Okay, so I'm going to jump in here because we have had a wonderful, thorough conversation about some of these things. I'd like to move the conversation forward a little bit and talk about expectations and pitfalls to avoid. And so we're scheduled to go another 10 minutes. And so the conversation around expectations and pitfalls really is from your experience. What do you see people think is normal when in reality it's not? Or what should a business owner or executive expect inside of this process of preparing your company to raise capital? What is a normal, and what's maybe a fun story of someone that wasn't inside of that expectation? Because that way we can all learn about this process. Michael, you're ready to go.
Yeah, I'll be quick on pitfalls. One, there's something called securities law. When you're bringing on a partner, even in your operating agreement, in your LLC, you bring in an employee and they want a little bit of equity and you give it to them, you're actually offering a security, and securities law applies. And when things fall apart, people sue each other and use the F word, securities fraud, and it ruins your day and your life, and you can't apply for anything, and it just really messes up your life going forward.
What does a security mean?
A security is you're offering an interest in the company that it's an interest in the company. It encompasses so many things: debt, convertible debt, but it's very broadly defined, but it's basically an interest in the company. Okay, so, but get some help. I have so many people come through the door, and I look at their last 3 years worth of emails where they told Sally, I'm giving you 5% of the company. In an email, there was never a document. Is that 5% of undiluted forever and ever that can never be, or what was it? And is it an option? Was that stock? What was that? No one knows. And And so it's really important when you're giving out pieces of your company to talk to someone. And then in the early days, I see people make the mistake of just giving out, because Grandma Sally was really nice to us and she gave us $10,000 early on. We gave her a little piece, and then her son, and then my Uncle Fred, and then you come down and now a Chris is looking at you, and you have 130 people on your cap table. Who are all these people? How'd they get a 1% in the company? And I would encourage you, don't be stingy about giving out equity in your company. Don't use your stock like the checkbook. I got lots of checks in my checkbook, and I can't pay people for things, so I'm just going to give everybody equity right now. That will come back and bite you. And then one other thing I'll just say is attitude early on. Back 20 years ago, in the Silicon Valley, people were smoking cigars in bar and saying, I have an idea. I'll give you $100,000 for that. It was the heyday, right? And then people thinking, and I'm going to raise this much, and then my company will be worth this much, and then I'll do another round at that, and it'll be worth that much. Why don't you leave that to Chris and the investment bankers? What you really need to focus on and what you do, we are all professionals, and we can get insurance, we can get your books in a row, we can make you a loan, we can find your capital, we can do your legal for you. But what you do that we can't do is you focus on running the business, differentiating yourself from others, creating value, executing, making revenue, make that cash. And believe me, if you produce something that's producing cash, there'll be people standing in line wanting to invest in you. And there's a lot of money out there.
Here's the follow-up question. What's a cap table?
Oh, sorry, capitalization table. Cap table is someone will ask you to show me all of the people who own stock or membership interests in your business. And it needs to add up to 100%, but it could have 2 people on it, you and Sally, or it could have just you on it, or it might have 130 people on there, and Chris is going to want to know, who are all those people?
Very good. So we're going to go through each person, since, sorry, we only have a few moments left.
I'll be brief if
we're
you
going to go through. Yeah. Was there a follow-up question? Go ahead, Chris.
I would say, look, none of us like to manage by surprise, and that'll sound common sense oriented, but it happens every day. And I'll give you for instance, per Don's request, but we made investments some years ago in an LA-based clothing manufacturer that became very well known and went public. I'm not a guy that takes companies public. And like I said earlier, the era of omission is worse than the era of commission. And, for instances at a board meeting, when you look at the general counsel and you say, is there anything else? And he looks down. Damn it, something's not right. In this case, very quirky CEO, strange, different, weird. So we had a problem of 17 sexual harassment suits that we didn't have yesterday, we have today. So my message in that is just be honest. Because whether it's me or him or her, we're going to find out. So the fact that you didn't tell me, now I got a character flaw issue. And that's worse than anything, because now I can't trust you. So just the more honest and candid you are, the more you're going to help yourself.
There are always surprises, and there's no surprises. There is not, let me say it another way. It's not uncommon to have something come up that you don't expect. Well, those kinds of things end up being skeletons. It is never worth it. Deal with it straight out, and everyone will appreciate it for you.
And it was in California, by the way. So.
I would echo that, because when we do a background check on a business and the owners, technology today allows us to do a deep dive into everything that's going on, and it's amazing what you'll discover when you do your search on backgrounds of people, and they forget to disclose that when they're sitting down with their banker or their investment advisor. That's a dead end. If we have to discover something that's quintessential to the guy's character or his business, and we have to find it and he didn't disclose it, game over. The other thing is a lot of people are out there raising capital and giving, as Michael said earlier, I see a lot of folks that are practicing investment banking that have no license. Do not do that, because there's a big penalty involved if you're involved with raising capital and you're not certified to raise capital. I have to laugh because when I started a bank, I don't know how many years ago, and I got the wild idea to do a de novo, and I did it, but I started building my memorandum by myself. I was an investment banker back then, and my attorney at Quarles and Brady called me and said, you can do that, but the liability you want to take on if you do that is enormous. So I immediately went downtown in Milwaukee and gave them the memorandum. Said, finish this up for me. Don't raise capital on a whim or with your buddies. Get good sage advice about cap, because it's expensive if you have a problem with it down the road. And as you said earlier, your business isn't doing well. The first thing that shareholders do when they're not qualified is they get an attorney to sue you. So be careful about that.
I suspect everyone on the panel would agree that just, again, to Chris's point, being open and honest up front, it's like a business partnership. We're here to support the growth of the company, that we want to partner with our clients. So being open and honest is critical in all aspects of the business. From an insurance standpoint, we talked a little bit about cyber. I can't emphasize the directors and officers, the D&O insurance enough. A lot of people say, "Oh, I'm a small company. Why do I need D&O insurance? If I'm publicly traded that way, that would make sense." No, given today's litigious society, you're going to get sued, and they're going to go after the deep pockets. If you have employees, odds are an employee may sue you at some point. It could be a sexual harassment suit. They're going to go after the company. They're going to go after the directors and officers. So you want that D&O policy in place. The other thing that I would caution everyone is I've seen it where people are trying to maybe cut costs and skirt the issues around work comp. I'm just going to 1099 this guy or this woman. And I've seen companies that structured, that's all they do. They have no employees, but they just have a bunch of 1099 people that are supposedly contractors. That is changing. If they're working exclusively for you in that capacity for the company, they're deemed an employee from a work comp standpoint. And that just opens you up to a huge audit exposure there. Another thing one quick point is California Assembly Bill 5 was passed last year, went into effect in January 1. And that involves, it stemmed from a lot of lawsuits around Uber, DoorDash, Lyft, people like that, contract employees. They took an 11-point test to define whether it's a contract or not, took it down to a 3-point test. And so all of a sudden it's a lot more broad. It's easier to classify them as employees. So what happens in California, unfortunately, a lot of times heads east. So it's going to be, you're going to have more people classified as employees. So that's a pitfall. Watch out.
Thanks.
I've been in public accounting for a really long time, and one of my favorite things to do is to help a business start here and eventually sell. You know what you're doing when it comes to your business, but you don't know what you don't know, and that's what you need professionals for. So I would encourage you to make sure you take advantage of that. I've seen deals fall apart at the last minute because of due diligence. They didn't think about some sales tax issue that exposed somebody to all kinds of additional liabilities. And that world is just different in general now because of Wayfair. States are still trying to figure out how they want to take advantage of that. So use your professionals. That's what we're here for. We want to help you. We find it exciting. We like to see all those little windows into things that we didn't even know existed. So we're here. Take advantage.
Awesome. Thank you. So we are at 1:02. So we are going to wrap up formally, and everyone is either going to stay for a few moments or pass out business cards or network or take off. But if you connected with one of these people, please take a moment to say hi to them, exchange business cards, follow up. They're an amazing resource for knowledge and experience. So thank you very much to Jill and the City of Tempe. Thank you very much to our presenters. Thank you very much to our audience.
Get up! Hey, is that how you answer a question? So you guys lack discipline today.